Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Asp Isotopes Inc. Annual Report. Asp Isotopes Inc. offers a diverse range of businesses and services related to isotopes production and distribution. The company operates in two main segments: nuclear fuels and specialist isotopes and related services. The nuclear fuels segment focuses on the research and development of technologies for producing high-assay low-enriched uranium, HALEU, and lithium-6, targeting the advanced nuclear fuels market. This segment also includes the production and commercialization of isotopes such as molybdenum-100, molybdenum-98, and ytterbium-176 for the nuclear medical industry. The specialist isotopes and related services segment engages in the research and development of technologies to separate high-value, low-volume isotopes like C-14, Ma-100, and Si-28. This segment also provides related services and operates PET labs. The company's Asp technology separates gas species and isotopes in a volatile state, while its quantum enrichment (QE) technology separates isotopes. Asp Isotopes Inc. develops various isotopes for different industries, including nuclear medical industry, zinc-67/68, nickel-64, xenon 129/136 energy industry, lithium-7, uranium-235, chlorine-37 semiconductor markets, germanium-70/72/74. The company's services and products cater to various target end markets, including pharmaceuticals, agrochemicals, nuclear medical imaging, and semiconductors. Asp Isotopes Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $1 billion. Asp Isotopes Inc. trades at a higher price-to-book ratio of 5.65 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 46% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for the companies mentioned can be categorized into common drivers and company-specific drivers. Common drivers include acquisitions, collaboration revenue, new revenue streams, and regulatory approvals. These factors have contributed to revenue growth across various companies. Acquisitions have been a significant driver of revenue growth, as seen in the case of QLE's acquisition of PET Labs Pharmaceuticals and East Coast Nuclear Pharmacy. Collaboration agreements with partners such as TerraPower and 137 Inc. have also generated revenue for some companies. The introduction of new products or services has created new revenue streams, while regulatory approvals have enabled companies to generate revenue. Company-specific drivers vary across the companies mentioned. For instance, Renergen's sale of helium and LNG has generated significant revenue, while its acquisition of Skyline has introduced new revenue streams through civil engineering services. QLE's collaboration agreements with TerraPower and 137 Inc. are expected to contribute to future revenue growth. However, challenges such as commodity price fluctuations, regulatory delays, and financing challenges can impact revenue growth. Revenue growth rates have varied across companies, with some experiencing significant increases, while others have seen more modest gains. The specialist isotopes and related services segment has been a significant contributor to revenue growth for some companies, while deferred revenue has indicated potential future revenue streams. The net income of the company experienced a significant decline between 2024 and 2025, with a decrease of $127.4 million. This downturn was largely due to ongoing research and development activities, regulatory challenges, and operational issues that continued to plague the company. As a result, the net loss increased from -$32.4 million in 2024 to -$159.8 million in 2025. The profit margins also suffered a substantial decline during this period. Since the company was not profitable in both years, its profit margins were implied to be negative. The actual decrease in profit margin was significant, with a drop of 24.3% from 38.6% in 2024 to 14.3% in 2025. This decline can be attributed to the company's inability to generate sufficient revenue to offset its expenses and losses. The stark contrast between the 2 years highlights the challenges faced by the company, which struggled to turn a profit despite efforts to address operational issues and regulatory hurdles. The decrease in net income and profit margins serves as a reminder of the need for the company to reassess its strategies and make significant improvements to achieve financial stability. The company's financial performance indicates a concerning trend. According to the provided information, the company has been experiencing negative operating cash flow for 2 consecutive years. This suggests that the company is struggling to generate sufficient funds from its core operations to meet its financial obligations. As a result, it may be challenging for the company to invest in growth initiatives or pay off debts, which could have long-term implications for its sustainability and competitiveness. The company's debt level has undergone significant changes over the past year. According to the extracted summaries, the total liabilities have increased by $191,941 from 2024 to 2025, reaching a total of $235,122 in 2025. This increase is attributed to planned additional debt instruments and build costs for Phase 2. Furthermore, the total debt has also seen a substantial rise, increasing from $43,181 in 2024 to $235,122 in 2025. On the other hand, interest expenses have shown mixed results. While some pages indicate an increase, others show a decrease. For instance, page 109 reports a significant increase in net interest expenses from $6,875 in 2024 to $123,719 in 2025. However, page 130 shows a decrease in interest expenses from $17,872 to $9,378. The overall trend suggests that the company's debt level has increased significantly, but its interest expenses have been inconsistent. The performance of various segments and regions within the company was mixed in the given period. Internationally, operations were underwhelming due to risks associated with foreign countries. Similarly, primary operations outside the U.S., particularly in South Africa, struggled with differing legal, political, social, and regulatory requirements. On a more positive note, certain business lines showed significant growth. Construction services revenue skyrocketed from $0 to $18.175 billion within 1 year, while specialist isotopes and related services saw an increase from $3.944 billion to $5.674 billion. However, nuclear fuels experienced a decline in revenue, dropping from $200 million to $0, accompanied by a substantial net loss. Regionally, Asp Isotopes Inc. Americas outperformed Europe and Asia Pacific, with a notable revenue increase of $13,580 in 2025 compared to the previous year. This suggests that the Americas segment was a bright spot within the company's operations. The management is expressing a cautious outlook for the company, citing significant net losses and uncertainty surrounding future revenue growth. Despite investing heavily in research and development, the company's profitability remains elusive, and it may need additional capital through equity and or debt financings to sustain operations. To achieve profitability, the company is focusing on expanding production capabilities, commercializing new products, and acquiring strategic assets. However, this strategy comes with risks, including uncertainty around funding availability and potential impacts on product candidates, headcount, and operations. The management acknowledges material weaknesses in internal controls over financial reporting, which may affect the accuracy of financial statements. Additionally, the company is still assessing the impact of adopting new accounting standards, which could further complicate its financial situation. Overall, the management strategy emphasizes growth through research and development, acquisitions, and expansion, but also highlights the challenges and uncertainties that come with these efforts. The company has made significant acquisitions and divestitures over the past year. In terms of acquisitions, the company has purchased various assets and intellectual properties from several companies, including Renergen 137, Inc., Clydon Proprietary Limited, Molybdos, and Isobio, Inc. Additionally, it has entered into agreements to purchase highly enriched Simonus-28 from multiple suppliers and acquired in-process research and development, IPR&D. The company also formed joint ventures with Skyline, including KC Glory JV, KC Geotech JV, and KCCRFG JV. Furthermore, the company acquired a 13.09% ownership stake in Reamag LLC for $3 million and an approximate 20% membership interest in Critical Minerals Investment for $20 million. These acquisitions demonstrate the company's efforts to expand its operations and increase its market presence. On the other hand, the company has made several divestitures, including the settlement of liabilities with consultants through share issuances. In January 2024, the company issued 100,000 shares for $195,000, followed by similar transactions in April, June, July, September, and December 2024. The company also exercised a warrant in April 2024, allowing a warrant holder to purchase 3,164,557 shares of common stock and receive gross proceeds of $5.5 million. These divestitures indicate the company's efforts to manage its liabilities and raise capital through various means. The company's financial activities have been transparent and well documented. One notable aspect of the company's operations is its approach to shareholder value creation. Specifically, it has chosen not to pay dividends to its shareholders. This decision suggests that the company prefers to retain earnings within the business rather than distributing them to investors. On the other hand, the company has actively engaged in share buybacks. By purchasing back its own shares, the company is able to reduce the number of outstanding shares and potentially boost earnings per share for existing shareholders. This strategy can be seen as a way to increase shareholder value without paying dividends. Concerns about inventory buildup or supply chain disruption are evident in several areas of the business. The helium market is experiencing a tight supply, which could lead to potential shortages, page 13. Additionally, there is a risk of losing key customers, which could result in lower revenues and harm the business, pages 1 and 2. The company also faces challenges related to its suppliers, with limited numbers for certain components, page 33, and potential material interruptions that could prevent or limit the ability to execute the strategic plan. Furthermore, there is a risk of supply chain disruptions due to ongoing military conflicts between Russia and Ukraine, page 52, as well as prolonged government shutdowns, changes in U.S. trade policy and tariffs, strikes, riots, and labor disruptions, page 53. Other potential risks include significant capital expenditures required to expand production from LEU to HALEU, page 63, delays in funding phase 2 due to conditional approval and potential inability to meet conditions precedent, page 66, and delays in construction caused by third-party providers or contractors, page 67. That concludes the financial summary for Asp Isotopes Inc. Feel free to comment below, and I will be happy to answer them when possible.